the reason that it looks like manipulation is that you know, any other futures market, let's say oil or wheat or whatever, right? Those are consumed, and higher prices for wheat, they encourage people to consume less because they want to save money, right? There's on one side you have money, which is the dollar isn't really money, but it's more moneyness than the wheat. It's more liquid. In the dollar / wheat equation, you have dollars on one side, you have wheat on the other side. So the higher the price of wheat goes, the where are we now? Silver's like somewhere between 77 and 85, or 77 and 82. The fact that I don't even know where it is within $5 tells you exactly where we are. I've lost track. I'll tell you what it's like over here. Just I'm getting a lot of calls from people who don't usually talk to me asking where they can get silver. One guy called me who has never called me before. I had one conversation with him about central banks. I was with him with his daughter and then son-in-law over Shabbat dinner a few months ago, and then I discovered that he has some central bank consciousness as to what's going on. But then he was like really alarmfully worried that if he makes the silver order now and at a company that imports silver here in a lot, that they wouldn't go through because China's about to shut down or something like that, or they're going to shut down exports, and he was really worried about getting a supply. So I was like, look, just make an order, relax, you can do it. You'll probably get it. If you don't get it, they'll give you your shekels back. Just a lot of nervousness and people looking at me a little bit differently. Usually it's like, oh, I'm intelligent, but I talk about gold and silver and I'm wasting my time with these little trinkets. But now it's like they're looking at me and they're less laughing. And I feel kind of bad because I know none of them have the money to stack anymore, because it's already like $80 an ounce. I mean, they should have done it when it was 20, but no, that's the thing about hyperinflation. Nobody goes all in until everybody goes all in, and then it all happens at once. So I don't think we're on the verge of hyperinflation like within days, because we still have to have one last major bank bailout or whatever the financial crisis is going to be. We haven't had that yet. So once that happens, I still expect a huge sell-off in everything, including gold and silver, but it would last maybe a few days or maybe even just a few hours. I don't even know. And then the Fed to print like something like $10 trillion overnight, and that should be the end. After that, it should be the end game, and I don't know, a few days to weeks after that. So we might have one more shot here, but we're getting to the 2-minute warning now.
Silver and gold markets operate heavily on derivatives, not just physical supply. Futures contracts allow more metal to be traded than actually exists, creating potential instability. While manipulation exists, it is often systemic rather than deliberate, a side effect of complex trading and margin rules. Sudden hikes in margin requirements can force mass liquidations, producing rapid price swings disconnected from actual metal value. Understanding this is critical for investors. Futures magnify risk and reward. Those who maintain physical holdings or carefully chosen options can navigate this chaos, while speculative bets without liquidity may be crushed.
I care about it a little bit because I do have a very limited amount of options. I mean, look, I run a newsletter. I can't just constantly talk about monetary philosophy. It doesn't change. So I do have to trade a little bit just to keep people interested on that level. But I don't, that's like a cherry on top. I wouldn't even say the whipped cream. It's less than that. So like, for example, I spent like a few $100s when silver first broke 50 on October 9th. I said to my subscribers, look, you may, if you have a few extra $100 or something, you may want to get a few SLV call options on, let's say, something way out of the money, like I don't know, whatever the strike was, because once silver breaks 50, it could go much higher very fast, because it's done that before. So we did that, and it made a lot of money. And I already sold out of most of that position. I still have like just a handful left. So I care, but I'm not like stressing over it. I made some nice profit, and that's all. Um, but if you're going to go all in on derivatives and make a bet on how fast silver's going to get to some target within a certain short time period because you have a $50,000 of debt to pay off and you're relying on that, it's a bad situation, because that's what the silver short sellers are looking for. If they can get you squeezed out, they'll do it. I don't know if they can, but look, we're in a theoretical. We have to acknowledge, as exciting as this is and all the positive emotions that bring up, we have to acknowledge that we are in very dangerous territory here, because the COMEX could jack up margin rates to 100% if they wanted to, which means that you don't get any leverage exposure. What is it now, like 40%? I don't know. It's I think it's measured in dollar terms, not percentage terms. Last I saw was like $30,000 or something. Could be off on that, but they could jack it up to 100% if they feel really threatened, and then that forces a lot of people out of positions because they suddenly have to fund. Like if you own, let's say you're a hedge fund and you own contracts in long positions in silver, 5,000 ounce silver contracts on, let's say, 30% margin. So that's 70% of the cash you don't have to put into that. And then all of a sudden they're jacked up to 100%. You don't have the cash. You got to sell those like immediately, or they'll sell for you by force. This is all technical stuff. I mean, there's nothing to do with the inherent value of silver or anything like that. It's just we're still in a derivative system. They still got a lot of levers to pull here. And you got to be careful. So if you're a stacker, keep stacking. Or if you have enough, stop. But I wouldn't sell here, because anything could happen here. Anything. We could go to 100 tomorrow. We go down to 50 tomorrow. I really have no idea.
Gold and silver aren't merely investments. They're divestments from credit. Currency is a liability of central banks, and all debt instruments are derivative layers atop that credit. In times of financial collapse, only tangible money can preserve purchasing power. The metals themselves are inherently liquid, unlike any other commodity. Their value isn't intrinsic. It is derived from widespread acceptance and scarcity. While technology or AI may drive efficiency, they remain dependent on these metals for production and industrial utility. In a credit collapse, gold and silver are the ultimate refuge, transcending hype and speculation to secure real-world economic value.
Yeah, back when I was on Seeking Alpha, and before I even started the Endgame Investor, I think this was in maybe 2019, maybe 2020, shortly after COVID. So I don't remember when, but I was hearing a lot about manipulation in silver, and I have a nuanced take on that. I don't deny that there's manipulation in silver. I don't think it's a conscious activity mostly. Every now and then you could have like a team of spoofers that get in trouble in JP Morgan, they get fined $100 million or whatever it is. That's nothing. It's just like air. It doesn't really affect much. The real manipulation is the existence of gold and silver futures themselves. That is the manipulation, because that allows people to sell more silver or gold than actually exists. And the exchanges justify that by saying, well, it doesn't matter if they have the silver. If they have the dollar equivalent of the silver contract in their account, then they can settle that in the dollar equivalent of the silver. If they have the silver, great. If they don't, at least we require them to have, if they're shorting a contract, because I had to sell a contract once, right? But to cover my long, I had to go the other side. So they require the full dollar amount of that contract, even if you have the silver in your account, even if you have the warrant, right? You still have to sell a contract short to deliver the warrant to somebody. So technically I had to short silver once, and I know what's involved to do it. The reason that it looks like manipulation is that any other futures market, let's say oil or wheat or whatever, right? Those are consumed, and higher prices for wheat, they encourage people to consume less because they want to save money, right? There's on one side you have money, which is the dollar isn't really money, but it's more moneyness than the wheat. It's more liquid. In the dollar/wheat equation, you have dollars on one side, you have wheat on the other side. So the higher the price of wheat goes, the less people want to buy it, or any other commodity like oil or lumber or whatever, right? Because these things are actually used. But for a money commodity like silver, when you have dollars on one side and silver on the other side, you have, if you're talking about industrial silver, then yeah, on that equation, the dollar is more liquid than the silver. But if silver keeps going up and up and up and up, the moneyness of silver starts creeping into people's consciousness, and the money in that equation becomes the silver. So that becomes the opposite of a consumable commodity. The higher the price goes, the more people want it instead of the less people want it. And that creates a very dangerous potential for a positive feedback loop, which will spell the end of all futures markets very quickly. And so what happens then is, again, this isn't conscious, but once the silver price keeps going higher and higher and higher and higher, it locks up more and more money there, and more dollars at least, and then all other futures markets get, whacked out, like we saw on, what was it, March 7th, 2022, with the whole nickel scenario. There's a short squeeze there. So this could happen, and not by anyone's conscious activity or conscious thought. It could lock up the entire futures market, and that's when the COMEX would have to act, not out of any malice or anything towards silver stackers, but for their own survival, which is exactly what the LME did when nickel exploded. They reversed trades because they had to. So be careful.
Beyond monetary functions, silver has crucial industrial uses. Solar panels, electronics, and medical applications require inelastic amounts of silver, meaning demand won't decrease substantially even at higher prices. Supply constraints are compounded by geopolitical factors, particularly China's export controls and centralization of refining. Dubai and India have emerged as critical hubs for physical silver trade, creating new market dynamics. Investors must track these global shifts, as industrial and strategic pressures can drive prices higher independently of speculation. The interplay between industrial demand, monetary demand, and geopolitical controls forms a complex environment that will define silver's trajectory in 2026.
Yeah, so that I did a top 10, and I would recommend your viewers to watch it. I think I did. It came out pretty well, I think. A lot of what I say subverts even what stackers like to say, like gold and silver are a store of value. I don't like that language at all. I mean, you could technically say it's a store of value, but that's just a function of the liquidity of these metals. Right? A money is just the most liquid commodity that exists. There's nothing else to it. We're overthinking it by saying that it's anything else than that. It's a thing that changes its price relative to every other thing the least. And that's why people hold, that's why it's a store of value, though value isn't a thing that can be stored. It's not, you can't put it anywhere. It doesn't like live in the atoms of a gold bar, right? It's a subjective thing, but the material of the gold itself has people subjectively thinking what its value is changing the least relative to everything else, because the most people want to buy and the most people want to sell at the same time. Well, what you were touching on was the myth number 10, that you can invest in gold and silver, right? You can't invest in gold and silver. You can only divest your credit, go back into money, right? The only way to get out of credit is to go into money. There's nothing below. The simplest form of credit is the US dollar, because all other credit is based on the US dollar. The only way to get out of the US dollar is to go underneath it, and that is gold and silver. So it's a divestment. When you have currency, a currency is just a liability note, a liability that's a ticket for pro rata everything that's on whatever central bank of whatever balance sheet of whatever central bank issues that currency. A dollar, a euro, a Japanese yen, it all goes back to that central bank. So owning that currency, whether in digital or physical form of literally cash on your mattress, or a CBDC, if God forbid that should ever come to fruition, that's all just a liability note of the central bank. So owning currency is an investment in those central banks. In order to divest from those central banks, the only way to go is gold and silver, because if you go higher in the pyramid, let's say you own debt, Japanese debt or treasury debt or whatever it is, that just goes higher and higher up the credit derivative, and that's like a leveraged investment in the central bank, right? So, for example, if you're gonna own gold, fine, you own gold. If you're gonna own a gold derivative, maybe you'll own GLD, which is less safe, and it's not gonna do you much good if everything goes down. But even worse, even more leverage than that would be the 2x gold ETF, like what's it called? UGL, I think. So the higher you go in the credit derivative, if you go into debt or you go into stocks or you go into whatever it is else that central banks buy, tech stocks, whatever. I think they even buy options now. So that's all an investment in the central bank. The only way to get out of it is to divest, and the only way to divest from the credit system is gold and silver. Because what happens when credit collapses is that credit is only in our minds. That the credit is the invention. Money is not an invention. Money is a natural thing. That's all it is. And the fact that we are exchanging and economic beings, that we trade with each other rather than strictly fight with each other. Of course, we fight with each other. We do that all the time. But we have the ability, unlike any other animal, to trade with each other. And we do that with liquidity. So we discovered what the most liquid commodity is wherever we were. It doesn't have to be gold, but in a global economy, it's gold. And that's what we use. And then credit is an invention. When credit goes away, all the stuff that's here is still here, so that if you can no longer buy anything with credit, you have to be able to buy something with something, and that the answer is you buy it with what credit is based on, which is money. And that's it.
Financial and geopolitical instability underpins precious metals' rise. Bank crises, hyperinflation in nations like Iran, and extreme actions such as state interventions in Venezuela show how fragile credit systems are globally. Even developed economies, including Israel, remain underprepared with minimal gold reserves. Political unrest, local protests, and rising social tension can accelerate shifts from credit to tangible assets. Investors observing global credit collapses, currency devaluation, and hyperinflation trends can anticipate opportunities to act. The underlying theme, wealth preservation, increasingly depends on moving away from traditional financial instruments into tangible, globally recognized stores of value.
It will always be the most liquid commodity. I don't think we're going to discover an element that's more liquid than gold. I think we've discovered as much as we can. We know all the periodic tables, so that we know all the elements in the universe, except for, I don't know, maybe after 116, we aren't able to put any more atoms together in a super collider to make a new element. But I think we're done with discovering liquidity in the entire universe, known or unknown. The periodic table is the periodic table. So there's nothing more liquid than gold. There will be nothing more liquid than gold. So it will always be the best money, no matter what happens. We're not going to escape being economic beings. And if you're going to tell me, oh, AI is going to take over, well, I have some good news that AI is also a function of the bubble, right? A lot of it hurts productivity, doesn't help it. I noticed, I see that even with a situation that my son was in just yesterday, taking some kind of test for a program, and it was all operated and translated by AI, and there were so many bugs in it that he couldn't do the test because this happened to a lot of kids because the system wasn't working and the AI was being stupid. So a lot of kids lost about 20 minutes of testing time, and they didn't get it back because the people that were administering it, they just wanted to go home. So it just messed up the whole thing. This is going to happen a lot. So AI is just it's a function of the bubble, and it will go away with everything else because there's a lot of silver that goes into all these chips that run AI, gold and silver and other metals, and people will need that when credit goes away, and they'll be hacking away at the machines so that they can have some actual liquidity, and we'll be in a different space. I don't think AI will go away completely, but the hype and the insanity surrounding every new thing will go away as people need to eat and don't have any credit because the credit is dead. It's going to be a very different reality. I do anticipate it being in 2026, but I caution, I've been wrong about that every time I've said it's going to be this year. But I can't, if I see it, I can't say, I don't see how it can keep going. I mean, I'm looking at international developments, Venezuela, the Trump administration I'm not for or against it. I'm just saying, kidnapping the head of a state that's a very extreme act. And we have hyperinflation in Iran. Suddenly, the rial, is that what they call it? The rial collapsed, and now there's revolution in Iran, which I'm happy about, but other people aren't. So I mean, I don't think it's a coincidence that Maduro is kidnapped and Iran is under a hyperinflation revolution at the same time. I mean, they're part of an axis, and the U.S. is also part of a group, and both are disintegrating at the same time. There's too much happening in the world right now for me to say that this is going to last beyond 2026. I don't see how it could. Yeah. And here I can definitely see that people are getting poorer. There's also some major protests that are breaking out here. The ultra orthodox. There was a huge event yesterday. It's very rare in Israel. There was a huge protest in one of the ultra orthodox neighborhoods in Mea Shearim in Jerusalem, and an Arab bus driver ran over and killed one of the protesters. This could lead to like mass, Jewish Arab riots at any point here. I'm kind of out of the picture. I don't live near any Arabs. It's just us and the Druze up here, and we get along fine. There's really no tension between us. But even here, and where things are much better than Iran, I mean, things are very tense. And I saw someone was passing around an interview of the Nagib Bank Yisrael, the chair, with the equivalent of the Israeli Fed chair, or the Bank of Israel. He was asked about gold, and this is the first time I ever heard him field this kind of a question. And he said, the question was, does the Bank of Israel have any plans to acquire any gold? Do you regret that you don't have any, that you're one of the very few countries in the world that has no gold, no real assets on your balance sheet at all? And so he gave this kind of waffling answer of, you can always, in hindsight is 2020, if we had known that gold would go up, we would have bought it. It was like treating gold as if it was some kind of like stock pick, right? But I was listening to this interview. I'm like, the shekel is toast. Forget it. It's gonna die, because these guys have no idea what's happening, and they don't know that gold could just explode higher, in days. And all the Bank of Israel has is dollars and a few other collections of foreign currency. That's it. They've got nothing.
Investors face a delicate balance: patience, liquidity, and measured exposure. High-risk derivative bets can produce massive returns or catastrophic losses. Conversely, maintaining physical metals, conservative options positions, and sector diversification offer protection while allowing upside participation. Understanding market mechanics, supply constraints, and geopolitical factors is crucial. Gold and silver will remain central to wealth preservation, particularly if credit systems fail. Future crises may accelerate price surges in hours or days, not years. The strategy is clear: respect volatility, focus on tangible assets, and recognize that the end game isn't speculation. It's survival and liquidity in a world increasingly divorced from stable credit.